So how do you know that a specific currency is likely to move so that you can decide whether to buy or sell it to make a profit? So the question is how do you know which way the currency you have found will likely move next? Well, the straightest and simplest answer is that I can give you is to follow our daily info that we share on the private network. We don't only highlight the best currencies to trade based on fundamental analysis, but we also explain why those currencies are being selected and which way we can expect them to move. But let's begin by looking at the biggest currency mover, which are interest rates. The reason that interest rates have such a big impact on currencies can be divided into two factors. The first one is the effects that interest rates have on investors. If an investor notices that the US has recently started to raise interest rates and they're likely gonna keep it higher for some period of time, then this makes the US dollar for an investor a very nice currency to have his money in, because the investor will get paid more by having dollars rather than having euro, for instance. So if the dollar is paying 2% a year and the euro is paying 0% a year, where would you like to save your money? However, keep in mind that in order for European investors to transfer their money from European banks to US banks, the investor must convert this euro into dollars. So every investor from outside the US must first sell his local currency to buy the dollar. And of course, this naturally will result into the US dollar appreciation against other currencies. And at this point, the second factor kicks in, and it's when speculators like us, but mostly big hedge funds and institutions, understand what's happening, and so they will start to position themselves to get in as early as possible. So they will start to move the beginning of the trend, and then the trend will be sustained by those large investors that will gradually come in the market. So the combination of these two factors, the speculators and the investors coming into the market, will help the US dollar appreciate against other currencies. Falling interest rates obviously have the opposite effect. And so this is why interest rates are closely watched by institutions and professionals, because the move caused by it is very profitable and stable. The key here is to understand banks' monetary policy and get ahead of them by predicting the next move on the actual data we have. So we keep the track of the data, and from that data we predict the next move that the bank will do. So thinking ahead of everyone else here is very important, because new traders most of the time, actually all the time, get messed up by following already priced in fundamentals. And with already priced in fundamentals, we mean that the move is already done. Because as I already told you, the market moves on expectations. So the market starts to price in the expected move that will happen. So newbies will start to get in at the bottom or at the top. But our job is to position ourselves ahead of the cycle and wait for it to end rather than jump in at the end of the cycle. Because we have the fear of missing out the trade. There will be plenty of trades if we miss that. So if you want to avoid that trap, you must be always sure that you're thinking ahead and that you are understanding the clear picture. Not only the short term, not only what's happening now. Because for instance, one central bank can hike rates now, but they might state that this is the last hike and then there will be more likely cuts heading into the future. So yes, they hike rates, but that was the end of the cycle, because now they are changing policy. You see here the expectations, not only what's happening now, but the expectation of what will happen in the future. So what else can tell us which way a currency will likely move next? Well, the key here lies within the central bank itself, because every central bank doesn't like wide moves into the market, because it's bad for business, of course. If everybody is scared of investing their money into the market, into the currency, because the central bank is acting unpredictably, then that will hurt the economy. So a central bank doesn't want that. And thus they will try to make their statement as smooth as possible and steady without any big surprises. So every statement they do they will try to make it as clear as possible and predictable as possible, so that the markets don't get too volatile when they take action. And this helps the market being stable too, but it also benefits us speculators, because we can predict what the bank will do. Now, it's important that you understand that each member of a central bank as a stance or an opinion on whether rates should be higher or lower. And based on their characteristics, we have three different categories for them. For those that prefer higher rates, they are called hawks. For those preferring lower rates, they are called doves. And the rest falls into the neutral category. So you should always keep in mind and keep an eye on the comments from the members, but keeping an eye on their usual stance. Are they a dove? Are they hawks? Because if a hawk is saying that interest rates should be lower, then that's a huge signal for dovish from the central bank. Because if an hawk, so a member that is usually more likely to prefer higher rates, is now preferring lower rates, is now looking to lower rates, that actually means that the conditions can be very bad. And so the central bank will soon look to act. And this of course works in every combination. This is why central banks are carefully watched, because it's not only what they do that gives us opportunity, but also what they say. And one issue here is that central banks know this, so they might use that on their advantage. And you will see this many times in your career. When the bank says he wants to do something that should move the currency in one direction, but the market actually doesn't believe it and it goes the opposite way. Or when a central bank jawbones the market, so they want the currency to go in one direction, so they jeopardize the monetary policy. So it all can be confusing at first, but with enough practice, you will get to know all the players in the game, and you actually will be able to predict their behavior more often than not. Because think about it, the same way you can predict the behavior of a close friend or a girlfriend, a boyfriend, wife, husband, the same way you can predict their behavior, you can predict the market. But of course that comes with time, right? You don't fully know a person by being with her for a few days or a few months. But you can actually fully understand her with just a quick glance after a few years. And on the opposite side, you don't want to get too comfortable, because you might think you know very well a person after a few months, and then they turn into a completely different person once you begin to know her intimately. And this concept, of course, applies to the market too. You can't impose your predictions or think you know it very well, or think you know it well enough after a few months. But it will always be after years and years of experiencing events in the markets that will help you know it. And this is why actually more experienced traders really get good in making money in the market. And the reason why most retail fail is because they never even realize these things. And they continued looking at pretty charts, fancy indicators, and dummy robots. And the last thing that I want to add, and another thing that is very important to come back, is to always keep in mind that currencies are traded in pairs. So we need to look for two currencies with almost opposite things going on. And this is called monetary policy divergence. So if you have the US dollar that is raising rates and the Canadian dollar that is lowering rates, then you have a clear policy divergence to profit from. So it actually makes sense to buy the US dollar and sell the Canadian dollar, thus buying the US dollar CAD. And the more extreme the divergence is, of course, the better the opportunity is.